Got a question from Frank J. Can you please share some insights where regional Victoria sits currently? If one should consider investing in regional Victoria, what the 3 to 5 year horizon looks like. So I guess first, I think we talked about this in the last mastermind session. The previous month prior to that, we'd been purchasing a bit over 40% of our acquisitions in regional Victoria at that point. And we've definitely seen a shift where probably if we were going back 12 months prior, we're probably only making maybe 5% or less of purchases in Victoria. And a heavy purchase amount was going into Queensland and WA. And now that's starting to shift. There's still some good buys, and it's definitely not that any of those locations aren't worthy considering in terms of being an investment. But I guess for us here at Ripehouse, we've historically always been trying to get into the markets earlier. So what I mean by that is we don't want to be jumping into the roller coaster ride halfway, 3/4 of the ride through, be overpaying for a property. Sometimes we might be able to get in and we might be able to purchase really, really well, which I guess to your question there, Frank, is definitely in Victoria at the moment. We absolutely have a lot of leverage in the negotiation phase. So we're kind of anticipating the first maybe 3 to 6 months in Victoria being a little bit slower on the capital growth rate. Though having said that, if we have a look here, it's not like Melbourne hasn't seen any growth in the last 12 months. It's not something outstanding in comparison to other areas. But if we're able to pick up a property, say 5% under market value, whatever it might be, and we still get another 5% or more of growth, that's still a pretty decent year. Where at the moment, you've even got some other commentators out there. I think Terry Ryder came out last month basically saying that he's off Perth. So again, for us, we want to get into areas, plant our seeds over a couple of years, and then move into other locations so we can get a really long growth cycle. So I guess for your question there, Frank, we really see that Victoria being a really, really strong buying window over the next couple of years for us. Will we go for the whole 5 years? I don't think we'll be buying for 3 to 5 years in Victoria. We would like to see that it having a strong 3 to 5 year period. But it's just, I guess, understanding where Victoria came from. So they went back whilst most of these other states were going forward for a couple of reasons. So in particular, Melbourne and Sydney are heavily impacted or tied to serviceability. So you see those markets tend to do a lot better when people either have more borrowing available to them or they're feeling more confident to get into those markets, which obviously over the last 24 months or so, we've seen rates go from 2s to 6.5%. So that Sydney and Melbourne market suffered, and then Melbourne, for whatever reason, decided to impart some changes onto the investor space, and that wasn't really seen as favourable. So you've had over the last kind of 12 months or so, you've seen investors kind of had been leaving the Victorian market because they didn't really like that land tax. And I think if there's always a hyperbole reaction when there are changes put in place, it's like you tell the kids they can't do something, they'll overreact, so it might not be that bad. But the reality is if people actually sit down and crunch the numbers on that land tax change for Victoria, it's completely different if you've got multiple assets. And the ones that are leaving Victoria typically tend to be those ones who have put all their eggs into the one basket and they've invested their entire portfolio into Melbourne. So a couple of reasons why they're looking to leave. So firstly, if they've been in the market, say the market hasn't really done all that much since 2019 in comparison to other markets. So if you've seen all these other areas outperform you, and then all of a sudden you're getting hit with a heavy land tax bill because maybe you have $2-3 million of land value in the state, you're all of a sudden going, hey, I've been underperforming and now I'm getting hit with this land tax bill, so I'm going to start to pile out. The other reason why some investors are piling out is it's not so much the land tax bill. They might be looking to reduce their debt that they've got on their portfolio because their interest rates have gone from 2% to 6.5%. Maybe they've got mortgages they're looking to pay down. So there's been a little bit of an uplift on supply. That supply is gradually being eroded and taken away. But for us, I guess what we of investors and what the algorithm has always been really, really bullish on, we love to see when vacancy rates are tightening. And in Victoria, if I was actually to pull open the Victorian map for a second, and we'll just go to Melbourne as an example here. If I could spell it correctly, that would be a good start. So if we go to Melbourne, and if we just go to vacancy rates as a whole, you'll see most of Victoria is in the 1% or less vacancy rates. And that's in Metro Victoria. We start to go out into maybe some larger regional areas. We'll go out to, say, where are we here? That's not what I'm looking at. Ballarat. There we go. So Ballarat, same rule applies. A lot of them here are 1% or less. Got 0.5 in. We're getting closer to town. And then we go out to somewhere more like a Bendigo. And again, the same thing applies. So where Victoria was struggling a little bit as well was the vacancy rates here, because a lot of people left to go interstate, etc. The Victorian economy is really heavily driven off migration, so international visas, international students coming into the country. So it's taken a little bit of time for that catch-up to happen, but the rental growth rate here in Victoria has been tracking very, very strongly. I think if we look here, about 7%, and that's only just kind of tapered off in the last couple of months. It was more around that kind of 10% number for the best part of time, where Brisbane's only been at 5. We had been in and around the mark around where Perth are at. So if you've got your rents growing faster than the houses are appreciating, we're starting to see, particularly in regional Victoria, a lot of these opportunities where they might be in the mid to high 4s yield. Sometimes they're even crouching into the 5 or higher. Those things are going to be attractive to investors. Not only that, it's also because you're going to have investors trying to move liquidity around. They're going to be looking to exit some other areas which, they've made good profits in other locations. So they might want to get into places like regional Victoria because they've seen their properties maybe in Perth, maybe in Queensland, close to go up to 50 to 100% over a period of time. And they're maybe not feeling as comfortable holding an asset that's 4, 5, 6 hours away from a major CBD, and they're feeling more comfortable in a regional location in Melbourne, which might only be an hour or 2 hours away from a metro location, and still see it as good value. So for us, we're still seeing vacancy rates. We're seeing that rental growth, and we're seeing, for us as well, we're seeing that increased volume demand of properties turning over, but we're seeing vendor discounting. So that's nearly perfect storm stuff for buying property for us. And then if we just go to social commentating, you're seeing places like the Pizza Property Podcast, Todd Sloan, Investor Kit, Terry Ryder. A lot of other property experts out there are also starting to talk up the prospects of buying into Melbourne. So again, everything is really tick, tick, tick for us. We're happy to be the early ones and be in there first, because we're very, very confident that as we go on, that's going to be the right decision. So thanks for that question, Frank.